You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California, on this second back-to-school episode of the week. And this one in particular is on asymmetric investing. Before I begin, though, let me remind you there is a website associated with this podcast. It's called wealthformula.com. And right now, I am particularly eager for those of you who are in the accredited investor status mode to consider joining us in the Investor Club. That is our private group for deal flow. And that is, you can sign up for that at wealthformula.com. You do need to be an accredited investor. Now, what is an accredited investor? As a reminder, it means you've made $200,000 a year for at least 2 years with a reasonable expectation of continuing to do so. That number turns to $300,000 if you're filing jointly or you have $1 million of assets outside of your personal residence. So those are the two ways you can do it. You either are one or you are not one. If you are one, I encourage you to get onboarded. Anyway, let's start with today's episode here. And we already had one episode that was really covering basics earlier in the week, and that was from Rod and Brennan. I mean, that is, I think, sort of the really, core, very safe money kind of thing in my view. That's my approach to it. Now, what I want to talk about today is sort of the opposite, the opposite and the extreme of that, which is asymmetric investing. Now this is the kind of investing where you put money in with the hope that the returns are going to be life-changing, but with the understanding that you could lose it all. And again, I call it, for that reason, asymmetric risk. And the reason that it is asymmetric is because you're not using huge sums of money. There's a huge upside, but hopefully not a lot of downside, nothing that's going to kill you. So here's an example of investing in the asymmetric fashion. Cryptocurrency. So back in 2017, I decided, hey, you know what? I was going to get a new car, but back then I was driving a pretty simple little 2007 Prius, and I said, well, gosh, I've got some money here. Maybe I should buy a car, but then I didn't feel like I should. Because I really was thinking I wanted to, maybe dip my toe into this whole cryptocurrency thing that I was learning about, but I didn't want to lose money. But then I figured to myself, hey, if I buy a new car, I am going to guarantee lose money, right? Because it's a true depreciating asset from day one. So I'm not going to do that. I was kind of frugal back then. I'm not frugal anymore. Now I'm, old and trying to spend money so that I enjoy my life a little bit. But back then I was very frugal, and I said, well, gosh, all right. So this is what I'm going to do. I'm going to take some of that money that I could use to buy a new car, and I'm going to buy a token that a friend of mine who was really in the know in the cryptocurrency space thought was going to be a really good opportunity. So I spent $50,000 in what was called a pre-sale, which is sort of like the pre-IPO. Back in those days, they were like sort of the wild, wild west. You didn't have to fill any accredited investor stuff out. There was no, private placements, whatever. I put in $50,000 and just to see what would happen. Again, thinking, well, hey, if it goes well, then great. But if I don't do well, then and I say I make 50 cents on the dollar, well, that's what's going to happen with that new car anyway. So when the thing started trading, right, I put $50,000 in token wise, and it started trading. It popped up in the first day, and my $50,000 was worth over $4 million. Okay, now that is the reward potential of an asymmetric type of investment. The downside risk of that investment was only $50,000. And while that was a lot of money, it wasn't going to kill me to lose it, right? I mean, I was going to put it in a depreciating asset anyway. So it wasn't going to kill me. But now $50,000 turned into $4 million. Well, unfortunately, the token was being sold on a Chinese market platform. And it was unavailable to Americans for the first month. And by the time I was able to trade it, it was worth a lot less. But anyway, that's another story entirely. You get the point, right? Millions of dollars have been made by people buying cryptocurrency or other kinds of asymmetric type of stuff, at least for those who actually sold at the right time. And I think that's something that you have to remember, because I know a lot of you have been up a lot, and none of us, sold probably when we should have. And that's another lesson entirely, is like quit while you're ahead. But now as I mentioned, there's other types of asymmetric investing as well. The Toronto and Vancouver stock exchanges are full of junior mining companies that have a similar risk profile to cryptocurrency. And believe me, I know, because I've lost thousands of dollars in the Great White North. And that was a space that I played around with, and I lost money. But again, you have to, if you approach it from day one thinking I could lose this money or I can make a lot of money, you don't feel quite as bad if you lose the money. Another one is penny stocks. I've never done penny stocks, but I guess that's sort of like the thing that was big in the 80s, right? Same concept. So should you consider asymmetric investing? Okay. And if the answer is yes, how much should you consider? I'm not here to advise you in any way, but let's just talk through some narratives so you can think about it. The answer is it depends. How much money do you have to invest? How much money could you actually afford to lose? So let's take a theoretical example. What if your cost of living is $50,000 per year, right? That's what your yearly nut is, and that includes, just you're not living like a pauper, but it's enough to get by. It's not enough for me to get by, but $50,000, say that was what your nut was, and you netted after taxes $75,000. Again, modest, right? Well, you probably wouldn't want to put too much money into that super risky stuff, would you? After all, there's not much money to invest in the first place. But what if, you were compelled to do so? Would it hurt you if you put 5% of that, that extra $25,000 a year you had to invest into something that could blow up, right? That would be about $1,250. Would it be worth putting into something that could potentially go to $12,500 or $125,000? Now, for me personally, I would think so, but that's up to you, right? Like, I mean, if you're making, if you could make, take 5% of your salary, or not even 5% of your salary, 5% of your investable assets that you're going to put in, and you have a potential of potentially making over an entire year's salary with that, I think that's a pretty good bet. It might be worth doing it, right? I don't know. On the other hand, again, if you had $25,000 to invest and you lost that $1,250 because your asymmetric bet was pretty much worthless, it wouldn't kill you. I mean, you wouldn't like it, but it wouldn't kill you, right? Now, when you have a lot more money, it might be more reasonable to up this amount of money as a percentage of your portfolio. Now, if you're someone who has an extra, say, $250,000 to invest, now you could just take that money, and maybe the smart thing is just to do the usual stuff: stocks, bonds, mutual funds, real estate, permanent, ultra high net worth, life insurance, retirement plans, wealth formula, banking, that kind of stuff, and solidify your spot into the world of upper middle class retirement. That's one option. Or you could take 10% of that investable $250,000 and put it in some asymmetric stuff and try to make an extra, $250,000 out of $25,000, or even extra $2.5 million out of that $25,000. Of course, you could, on the other hand, lose all of that extra $25,000 instead of making it grow in any sort of way. But the good news is that probably would not affect your ability to procure that upper middle class condo on the golf course later on in life, right? It's not a huge loss. So that's the perspective I'm trying to get you. Now you get the point. As former NFL coach Bruce Arians says, no risk it, no biscuit. And to be clear, I am not advocating for you to hunt out asymmetric opportunities. I'm just kind of explaining to you the appeal of doing so. Now, ask yourself why the rich get richer. Well, in 2008, let's use the example of Cameron and Tyler Winklevoss. They were the Winklevoss twins, if you watch the Facebook movie, right? And they settled with Facebook after claiming that they basically were ripped off by Mark Zuckerberg. And from that, they got $65 million. Now, they could have rode off into the sunset and let their money grow to centimillionaire status each, but instead they took a gamble. In 2013, they bought $11 million of Bitcoin between them at $120 per Bitcoin. Well, that asymmetric bet moved them into billionaire status. Had the experiment failed, would there have been a material difference in lifestyle between $27 million each compared to $32.5 million each? Probably not, right? But a billionaire status is a lot different than an eight-figure status, and that's what they did. Now, hey, you might say, who cares? It's a lot of money either way. But if you want to position yourself to buy an NFL team, you're going to need to make some risks like that, right? I mean, you're going to need to take some risks. Again, not for everybody, but that's the idea. If you want to fundamentally change your place in your socioeconomic hierarchy there, then you may need to do some asymmetric risk investing. Now, by the way, I heard that the Winklevoss twins are in trouble with the SEC right now for something related to the crypto platform Gemini they started, but they were a couple $2 billion net worth each, so I'm sure they're going to be just fine. Anyway, as for my own asymmetric bets, they are mostly in cryptocurrency. I tried, like I said, junior mining. Never went well for me. I also tried energy stocks. And in energy stocks, I had a uranium bet that did a 10x, which we called a 10-bagger. I should have cashed out, but I didn't. And I thought it was going to go higher. The lesson that I've learned from my crypto investments and that uranium investment, by the way, is that you should probably set an exit target early on and decide, okay, that's what we're going to do, and we're going to keep with it. And if it gets there, you're going to sell, because otherwise these things are so volatile, and you end up, regretting it. No one's ever regretted, selling when they were 10x above where they bought. Anyway, so I've been in cryptocurrency, for example, for about 6 years now, and I have literally been plus or minus several $1 million. I never sold when I should have. And even though right now I'm still way ahead because I got in so long ago compared to others, had I locked in profits when I should have, I would have been millions of dollars richer over the years. So obviously I'm not a pro when it comes to this whole asymmetric investing thing. But even the pros, hey, listen, even Michael Jordan's going to miss a basket once in a while. That's what they say. And you just keep trying. Anyway, I'm curious what your thoughts are. Let me know. Next week, I'm going to publish an interview with the president of one of my asymmetric bets in cryptocurrency. It's called Hedera. So check that out. But that's it for this week. Hope you enjoyed it. All of this back to school stuff. This one being on asymmetric risk. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.